Welcome to the deep dive. We're here to cut through all that market noise and try to find some of those hidden gems, insights that often just get overlooked.
hmm
So today, our mission, our deep dive, is really about exploring how you can identify undervalued stocks. We're talking about companies that, might be facing some short-term headwinds, maybe navigating choppy waters, but underneath, they possess some really strong long-term potential.
Right. It's not about following the herd.
Exactly. It's about taking a contrarian view, a smart one, hopefully, to uncover some potentially significant opportunities.
Hmm.
We're digging into a recent article, going, beyond the headlines to really get the nuances.
Yeah. Understand what's really going on.
And when we say undervalued, we should probably define that a bit.
Good idea.
It's not just a buzzword. We mean company is often trading at these, incredibly low earnings multiples.
Basically cheap relative to their profits.
Yeah, for every dollar the company is expected to make, the market isn't willing to pay much right now.
And that often happens because the market's feeling a bit down on them, a bit pessimistic or bearish, as they say.
But that pessimism, as we're going to explore, that might actually be where the opportunity lies. I'm genuinely excited to dissect these ideas with you.
And you should be, because this is all about a core investing idea. Contrarian investing. It might not, feel right instinctively, buying into companies that aren't exactly flavor of the month.
Right, it goes against the grain.
But the principle is solid. Strong fundamentals, combined with maybe just a temporary wave of market doubt. Well, that can create situations where patient long-term investors might find really exceptional returns.
Seeing beyond the immediate noise.
Precisely, beyond the headlines.
Okay, so let's really get into this contrarian idea because it feels counterintuitive.
It really does.
Our gut often tells us, chase what's hot, what everyone else is buying into. So why? Why would you deliberately look at stocks that, seem like they may not be doing all that well right now?
That's the million-dollar question, isn't it? The logic is you need to peel back the layers of that current sentiment, which is often emotional, frankly, and instead focus really hard on the underlying strength of the business itself, its fundamentals.
Yeah.
Now, this isn't about quick flips or timing the market perfectly. It's a strategy built for holding long-term.
Okay.
What you're often seeing is the market overreacting, dramatically sometimes.
Overreacting to temporary stuff.
Exactly. Temporary setbacks, short-term challenges.
Yeah.
The market sometimes thinks in straight lines,
Yeah.
sees its dip and assumes it's a permanent decline, even if the core business is actually quite solid. So when everyone gets overly pessimistic, that can create these chances to buy good companies at, frankly, bargain prices, buying dollar bills for 50 cents, as the saying goes.
Right. So for you, the listener, this is maybe the key takeaway here. It's a mindset shift, isn't it?
Oh, absolutely crucial. How you process market news.
Retraining yourself to see those dips, that negative sentiment, not just as danger, keep away signs,
but as potential entry points.
Yeah.
For strong businesses, if the underlying story still holds up.
Requires patience, though.
Patience and doing your own homework, making an independent assessment of value, not just following the crowd.
Okay. With that contrarian hat firmly on, let's look at a real-world example. First up, Vertex Pharmaceuticals, VRTX, big biotech company.
Yep, well known.
Now, on the surface, its year has been, lackluster is the word used, down about 2% year to date.
Which for a growth stock isn't great.
No, definitely not stellar performance, but it's also not a total collapse, is it? It feels more like investors are just sort of pausing, maybe shrugging.
A holding pattern, maybe?
So what's the market potentially missing here? What's the overlooked piece that a contrarian might be looking at?
That's exactly it.
Yeah.
See, right now, Vertex has this incredibly solid, successful business in cystic fibrosis, CF.
Yeah.
That's where almost all their revenue comes from currently. And it's still growing up 7% to $5.7 billion in the first half of the year. Solid.
7% growth sounds pretty good.
It is good. But here's the catch. The market labels Vertex a growth stock. And in that category, investors often expect, 20%, 30%, even higher growth rates.
So single digits, even if profitable and growing, feels slow by comparison.
Exactly. It can trigger that pessimism we talked about. Investors chasing hyper-growth might just overlook it.
So they're pricing it based on that 7% growth.
Pretty much. They're pricing it like a mature CF company, not considering what might be coming next. That creates the potential undervaluation.
Okay, so the market sees slow growth for its category and gets a bit nervous. But here's where it gets, I think really interesting. That apparent slow growth could be seriously misleading because Vertex has this pipeline, a really exciting pipeline of potential long-term growth drivers, things beyond CF.
Absolutely. The pipeline is the potential game changer here.
Tell us about some of those.
Okay, we'll take Casgevy. This is a cutting-edge gene editing therapy.
Gene editing, wow.
Yeah, for rare blood disorders. Things like sickle cell disease and beta thalassemia, which is this serious inherited blood issue.
Okay.
Casgevy could genuinely be a blockbuster drug by the end of the decade.
Blockbuster meaning over 1 billion in sales a year.
That's the threshold, yes. Then there's Vertex. It's a non-opioid pain treatment. Moderate to severe acute pain. Just got approved.
Non-opioid pain relief is huge.
Very significant market need. And they also recently bought a company, Alpine Immune Sciences.
Okay, what did that bring?
That gives them access to something called povetacicept. It's a potential treatment for a specific kidney disease, IgA nephropathy, and it's already in late-stage trials.
So multiple shots on goal, really. Sickle cell, pain, kidney disease. That's diversification.
Exactly. What's fascinating is how these developments could fundamentally change the company's whole story, long-term.
Great, it's not just the CF company anymore.
No, you've got massive future earnings potential and diversification. Add that to its current financial health. It's a big company, $102 billion market cap. And look at its gross margin, 86%.
86%. That means that they keep 86 cents of every dollar after making the product.
Pretty much. That's incredibly efficient. It shows underlying strength. But the market, arguably, is pricing Vertex mostly on its current CF business.
That's single-digit growth.
Yeah, and effectively giving you a big discount on what could be multiple future blockbusters down the road.
Which brings us to valuation.
Right. So Vertex trades at a forward price-to-earnings ratio, PE, of about 20.
Okay, and PE is how much investors pay for future earnings, roughly.
Exactly. Now compare that 20 to the average S&P 500 stock, which trades around 24 times forward earnings.
So it's cheaper than average.
Cheaper than average, but with potentially way above average growth coming from that pipeline. That 20 PE, it really starts to look like a bargain.
A steal of a deal, perhaps.
For a long-term investor who believes in that pipeline and is willing to be patient, yeah, I'd say that's a fair description.
Okay, from cutting-edge biotech, let's shift gears completely. Let's talk logistics. United Parcel Service, UPS.
Big brown trucks. Everyone knows UPS.
Everyone knows UPS. But the stock, it's seen a much steeper drop than Vertex, down over 30% this year.
Ouch. Yeah, that's significant.
And a big factor cited was this controversial decision they made. They decided to slash their shipments with Amazon by half, 50%.
Whoa.
Okay, cutting Amazon volume. That sounds, on the surface, like deliberately hurting your own business in the short run, shrinking your revenue. What's the thinking there? What's the strategic play?
It definitely looks like short-term pain, no doubt about it.
Yeah.
But it's actually a classic example of a company making a strategic bet for the long haul.
Okay.
UPS's reason. Better profitability, better margins.
So Amazon wasn't very profitable business for them.
Amazon is massive volume, obviously, but often it comes at lower margins.
Yeah.
Negotiates hard. So by cutting back on that less profitable chunk, UPS is tying this into a bigger strategy. Trim costs, boost efficiency across the whole network. They're aiming to save something like $3.5 billion in costs this year alone.
$3.5 billion, that's serious cost cutting.
It's very serious. Now, you're right. Cutting Amazon deliveries will make the top-line revenue look smaller for a while. And you've got other headwinds, too. E-commerce has slowed down a bit. There are tariffs, rising costs. Yeah. Those are real challenges.
So it's not an easy environment anyway.
Not at all. But the company is fundamentally trying to reposition itself, become leaner, meaner, more profitable.
So it's like they're taking some pain now, sacrificing some immediate size for better health later. A bet on higher quality revenue.
That's a great way to put it. Precisely. If you connect this to the bigger economic picture, this kind of short-term pain, if the strategy works, could pay off really well down the line.
How so?
Well, when economic conditions are tough, like they are arguably now, focusing on efficiency, cutting less profitable business, getting costs under control, that's smart management.
Right. Prepare for the winter.
Exactly. And economic cycles always turn, eventually. When things pick up again, UPS aims to be in a much stronger position because it'll have these leaner, more efficient operations already in place. Yeah. That makes the business they do have more profitable. And look, it's still a huge company, $72 billion market cap, and a decent gross margin already at 18.32%. They know how to run an efficient operation.
Okay, and the valuation reflects this pessimism.
Oh, absolutely. It's trading at a forward PE of just 11.
11. That seems really low for a global giant like UPS.
It's remarkably low. Some might even say dirt cheap. And there's another kicker for long-term investors.
Yeah.
The dividend yield. It's currently offering a, well, mouth-watering 7.74%.
7.7%. That's huge. So that's the annual payout relative to the share price.
Exactly. So even while you wait for the strategy to pay off and the stock price to potentially recover, you're getting paid quite handsomely.
This really shows how understanding why management is doing something, their strategic thinking, is so important, right?
Yeah.
Not just reacting to the headline number like revenue dropping.
Absolutely key. Looking past the immediate noise to the long-term plan. That's the essence of identifying these kinds of potential opportunities.
All right, our third and final case study takes us into telecom and entertainment, Comcast, CMCSA.
Another household name, cable, internet, NBC, Universal.
Right. Now, its shares are down about 9% this year. Not as dramatic as UPS, but here's the thing. This isn't just a recent dip. It's been lagging for a while, down over 20% in the last 5 years.
Yeah, that signals a more persistent issue, doesn't it? Longer-term struggle.
It does. So with that kind of track record, what's the fundamental problem here? What's weighing on Comcast? And how does a massive company like this even try to turn things around?
You put your finger right on it. The big elephant in the room for Comcast has been its debt, a high debt load.
How high are we talking?
Around $100 billion.
Wow. Okay, that's a number you can't ignore.
Impossible to ignore, especially when interest rates are higher, like now. That debt becomes more expensive to service, and it just weighs heavily on investor sentiment, pushes down the stock value.
So that raises the critical question. How does a company saddled with that much debt and a history of underperforming the market actually reposition itself? How do they win back trust?
And they are trying to respond strategically. You can see moves being made.
Like what?
Well, they're actively trying to get leaner. They're spinning off a lot of their traditional cable assets into a whole new separate company called Versant.
Okay, spinning off the cable stuff, is that just like rearranging deck chairs, or is it more fundamental?
No, I think it's more fundamental than that.
Mm-hmm.
This move does a couple things. One, it helps reduce that massive debt load on Comcast's remaining balance sheet.
Yeah.
But maybe more importantly,
Yeah.
it allows the remaining Comcast to really refocus. They're keeping the assets they see as having the best growth potential.
Here, Char.
The big NBC networks, their theme parks, which have been doing very well, Universal Studios, and crucially, their Peacock streaming service.
So shedding the older, maybe slower growth cable side to focus on media, entertainment, streaming.
Exactly. It's not just about cutting debt, it's a strategic pivot. It's designed to improve efficiency and pour resources into what they believe are their best bets for future growth. It's kind of an admission that, yeah, cable was great, but the future is probably elsewhere.
Makes sense. It's a big shift.
It is. And look, it might take time for the market to fully buy into this news story, to reprice the stock based on this leaner, more focused Comcast. Change takes time to be recognized.
But the underlying business still has clout.
Oh, yeah. It's still a giant, $123 billion market cap. And its gross margin is solid at 58.17%, so the core businesses they're keeping are profitable.
And the valuation now, given the debt and the spin-off plans.
Reflects the uncertainty, I'd say. The forward PE is just 7.
7. That's even lower than UPS, exceptionally low.
It really is. And again, there's a dividend here too, yielding a pretty solid 3.83%.
So for you, listening, this shows how even huge companies can tackle really big, long-standing problems like massive debt, right? By making tough choices.
Exactly. Making difficult strategic decisions to try and unlock future value. Even if it means investors need to be patient and look at the long game. #tag synthesis and listener takeaways.
Okay, so we've looked at 3 really different companies here. Vertex and biotech, UPS and logistics, Comcast and media and telecom. What's the common thread? What's the big takeaway insight for you as someone just trying to stay informed?
Well, I think the pattern is pretty clear across all 3, isn't it?
Yeah.
Despite the current market mood, whether it's pessimism, maybe just indifference, despite the short-term bearishness, each of these companies seems to possess strong underlying fundamentals. They're not broken businesses.
Right, and they're not just sitting there. They have active strategies.
Exactly. Strategic initiatives specifically designed to tackle their current challenges. Vertex building its pipeline, UPS focusing on margins, Comcast shedding debt and refocusing.
And crucially, because of that current sentiment, they seem to be trading at attractive valuations, at least if you have a longer-term view.
That's the key. Attractive for patient, long-term investors.
It really hammers home the importance of critical thinking, doesn't it? And doing your own analysis.
Absolutely vital.
Yeah.
You have to develop that discipline to look past the immediate headlines, the daily noise,
Don't just see what's happening.
but understand the why. Why is management making this move? What's the long-term potential here? Is the market overreacting or missing something fundamental?
That's how you build a truly informed perspective, I guess.
It really is. And it's how you might spot those opportunities that others are just too busy reacting to, or maybe they're just missing entirely because they're caught up in the short-term story. Hashtag tag tag outro.
Absolutely. Well, I think what we've talked about today really shows the power of, patient, deep analysis, how it can potentially uncover significant long-term value, even in stocks that the market seems down on right now.
Seeing beyond the immediate negativity.
Yeah, looking past the noise and maybe investing in that underlying strength, that strategic vision.
And, that leads to maybe a final provocative thought for you to chew on. If this approach, looking past the market's pessimism to see the underlying strength, can work for finding opportunities in stocks,
Yeah.
what other unpopular ideas or overlooked insights might be hiding out there, in plain sight, in areas completely outside of finance?
Like where?
Maybe in your career choices, personal projects you're considering, even broader trends in society. Where else might a contrarian view, a deeper dive, reveal hidden value or opportunity that everyone else is currently missing because they're focused on the challenges?
That's a great question. Applying that contrarian analytical mindset more broadly. Food for thought.
Definitely something to think about.